force him to second guess Brain on the various issues. Kendall, of course, has introduced himself and appropriately introduced himself. But let's just face it, I mean, he's one of the leading commentators. You look out there, he's written about it, he's been thinking about this for a long time, and really a great advocate for the industry. So I will, I guess, turn this over to Michael with the first question, which is, so equity crowdfunding, will this work and when?
This is working. Okay, good.
Yeah.
Yeah, I'm very bullish on equity crowdfunding. In fact, I don't know of anybody more bullish than I am on Title III, equity crowdfunding, which is the SEC has not passed that yet, but they will probably by August, I imagine, and that will enable investors, the mass consumers, to basically make private investments in deals. So I'm very excited about that. I think the equity crowdfunding space, I've been in the capital markets since 1977 when I joined Merrill Lynch, fresh out of college, and I've seen a lot. I was on Wall Street, actually underwrote IPOs. I've been an analyst. I've been a portfolio manager. I created an algorithm that automatically diagnoses public companies for cash flow problems, and I predicted the bankruptcies of several companies, including, Lehman and Bear Stearns and all these companies, all their problems a year before it happened, using my cash flow metrics. That's purely my cash flow algorithm that I developed. But what I see, I'm really excited about crowdfunding, because what's happened is the markets have opened up, are going to open up due to the 80-year-old ban being lifted that the SEC put in place. So this advertising is going to the ability for the public for the first time in 80 years to advertise, or the issuers to advertise, to raise capital for the first time since 1933, is going to enable open up a huge secondary market, a secondary capital market that I believe is going to dwarf the actual public markets within the next 5 to 10 years. There's actually on my at onlinefinancialsector.com, there's actually a video on that site that explains what's going to happen it explains the relationship between equity crowdfunding and finance crowdfunding, and it ties it to the web back in 1995. This all started with the web in 1995. The web came along. It was the Netscape unveiled the browser. The population grew of internet users when they did that. The first commercial browser from 16 million to 360 million by 2000, and it took Yahoo, eBay, Amazon, all these companies up with it. And so the money here is where the money's going to be made is who's going to service all this huge crowd that's coming. I'm projecting the crowd's going to grow from 200 million at the start of last year to 4 billion by 2018. That's a 20 times growth rate. And of course the biggest area where I see the growth is going to be, I believe that we're going to see the crowdfunding channel like the home shopping channel for Title III deals. That's what I see where this is going. And I believe it's going to unleash just a tremendous amount of deals that are going to get done. So I'm very, very bullish.
I want to, I guess, throw it over to David, because you have had experience, obviously, over the last couple years here in Georgia. Do you share that same optimism, and what do you think the challenges are to get from here to there?
Yeah, I mean, obviously I'm bullish on equity crowdfunding, debt crowdfunding. I think that the Jobs Act, implementation of the Jobs Act, which has not happened yet, will be key to building the momentum that we need. So equity crowdfunding here in Georgia has been slow. The rules have been around for 2.5 years. The first portal, we were the first portal to come on, and that was about 1.5 years ago. We have a ton of companies that are interested in equity crowdfunding in the state of Georgia. What we don't have and what we're working on doing is building awareness of crowdfunding among the investor community. So that's really what the slowdown, in my view, has been. But I think that nationally, the long-term view or prediction for crowdfunding is, I think, is going to be huge. It's a much easier way to raise capital. It's a much easier way for people who are kind of outside the normal networks that could raise capital will be able to get money for their company. So obviously, I'm very bullish on it. It's been a slower start than people had expected, but I think equity crowdfunding is still going to be strong and going to be here. But we need implementation of the Jobs Act to really get us to the mass level that we need.
Do you agree with that, Kendall?
Well, I'm bullish on equity crowdfunding eventually. You know, my concern is that in order for it to become bullish for all of us, there needs to be some changes. But ultimately, what's really interesting about this is when you talk to, it depends on who you're talking to, and that's what I think is the most interesting thing about this. If you go to a broker-dealer, or if you go to a banker, or you go to the traditional investment world, they're going to tell you equity crowdfunding is never going to work. This is the stupidest thing in the world. No one's going to do it because, of course, it's taking money out of their pocket. And it's changing an industry dramatically. So they're the naysayers. Unfortunately, they're a very powerful group of naysayers. And the beautiful thing about crowdfunding is it doesn't rely on those people. It doesn't rely on the traditional markets. It doesn't rely on the bankers. It doesn't rely on us lawyers that are up here. It relies on the crowd, the people. And so when I got involved in this, you know, a couple of years ago, I took it upon myself to go out and try to educate the masses as much as possible. That's why I write for a very popular magazine, Entrepreneur, not an industry magazine, Compliance Week or something like that. I get quoted in there, but I'm talking to the masses. I'm trying to teach people what's out there because ultimately this is going to work if the people, the crowd wants it to work. And so I think it's very important that we all stay bullish on it and ignore the naysayers. Look, yeah, there's some things that are wrong with this law. They'll get fixed. Yeah, the SEC may not like the law. It's going to be fixed. It's going to work. And in the meantime, you have great innovators in the states that are going, all right, let's fix these problems now. Let's create a model that'll work. And then ultimately, parts of the Jobs Act are already working. You know, Title II is working. It may not be working as big as people think, but it's working. Title IV is going to be phenomenal. Title III is going to work eventually. It may not work right at the beginning the way everyone wants it to, but it will. So everyone needs to stay focused on pushing this forward. I believe educating the masses to understand it because that's where ultimately the power is going to come from.
All right, so Brian, now you could touch on every single one of these topics, but you are obviously someone who's been very active in a lot of organizations and have written not for Compliance Week, but you are well known as an expert in this area. I want to talk though first about intrastate crowdfunding, a little bit about you know, David's experience here, not to step on tomorrow's panel, but a little bit about David's experience here, and then your thoughts about how intrastate crowdfunding can work and what you're trying to do about it.
So intrastate crowdfunding is interesting because it uses a very little known up till now exemption from the federal securities laws, which states that if your offering is only contained to a single state, then you need not register with the SEC. This had not been used very widely in the past until the crowdfunding movement seized on it. And I think it seized on it as a reaction to Title II and Title III. Just so that everyone is aware, Title II is the ability to raise money from accredited investors only. Title III is your ability to go out and raise money from the general public. The proposed rules on Title III are extremely onerous. There are burdens in place that are matched with raise limits and investment limits. I have a few materials in the other room, which you can pick up on the CFPA table, which delve into details on what exactly you have to do to comply with Title II and Title III. But it's all about the money. And if the people and the investors and the companies can make money, then it will work. The prevailing view right now is that Title III is so burdensome that absent some particular circumstances that we've discussed, for example, the TV show where you're investing from home, just like you can vote on Dancing with the Stars or American Idol, that has potential because you can get scale, and you're also going to be able to raise amounts that will pay the professionals. A company that is looking to raise capital, though, in an ordinary sense, has to pay a funding portal in the Title III world. They have to file with the SEC. They have to make ongoing reports with the SEC. And it makes it one of the more expensive ways to raise capital as compared to other mainstream sources. So I think that Intrastate is a response to that by stating that you don't have to go to Title III. You can still go to the public as long as you keep your offering within a single state. The SEC came out, or some staff members at the SEC who speak at conferences, quote off the record, but then they're broadcast, have expressed the view that anything that is not confined to the state would be a per se violation, and therefore you can disclaim away the transaction is only made in Georgia. We're only accepting investors in Georgia, similar to gaming laws where you can only play casinos online in the state of New Jersey, Delaware, and Nevada. The question will be kind of who wins that battle, and eventually if the SEC decides to take action against the states, which is something that they are thinking about but haven't expressed a view, probably because people at the SEC don't themselves agree. What I think will work with Intrastate, and one of the burdens I think of Intrastate is also that you have to be incorporated in the state where you're doing the transaction. And so if you look at the Invest Georgia flyer, there's a very good layout of what's required. But if I'm in New York, I can't go to Georgia very easily and raise money in a Georgia transaction. I am working with the Crowdfunding Professional Association, which is a very good organization. Charlie in the back is the president. Feel free to talk to him. And what we're working on is something that would be a uniform state exemption, state crowdfunding statute. And that would enable the laws of each state to be more or less the same or very similar to each other, similar to other uniform statutes, Uniform Partnership Act, Uniform Commercial Code, so that there's some predictability of the laws from each state. You don't have to hire 50 law firms to figure out what the rules are. Many states have put out their own intrastate exemptions, Georgia, Michigan, Maine, for example, Kansas, I believe, and a handful of others are considering it. And I think that it would serve the profession well to standardize the rules a little bit so that everyone can be more or less on the same page. But long story short, I think it has great potential. I think that it will only work in states that have a critical mass of population who are engaged in online investing. A lot of people out there have never heard of Kickstarter, have never heard of Lending Club, don't know what crowdfunding is. We sometimes live in a little bit of a bubble in that sense. And so I think awareness over time will definitely help.
Now, Michael, you win the most optimistic on the panel award, and so I want to go back to you and kind of explain in your thought process about where that growth comes from. What sort of companies do you see?
Here's what's going to happen. I was while I was in Wall Street, I was underwriting small public companies, practically almost venture capital stage public companies. So this thing is working, right? Okay. And what I found is that there are so many people out there that understand the leverage that you can get the leverage. That the reason why I like Title III is you can raise $100,000. Anybody in this room can go out tomorrow and come up with an idea and put it out there and start, they can call their uncle, they can call their nephew, they can call their brother, and say, I got this idea, and because we're all so closely connected, there's some entrepreneur that's going to want to link up with them. So what's going to happen is the guy's going to come up with an idea, he's going to come up with a partner, say, hey, listen, we can raise $100,000 for this thing. I think angels will put up capital just to do this. Then you go out under Title III, you float an ad, you raise your first 100. Okay, now, but the whole goal here is to raise $1 million. It's not to, people are looking at Title III as 100, 500, and $1 million. I'm saying that's not going to work that way. People are going to go out and raise 100. Okay, we've got all of our ducks in a row. Let's get our audits. Let's get all this done with the first 100. Now we're going to get the 500, which only requires a review. And now we're going to go get the next 500 that requires the audit. That's the way it's going to work. And guess what? We can do that every year. So there's going to be opportunists who are going to come out of the woodwork. And what's going to happen, you're going to see a lot of deals are going to get funded much faster because, again, from what you said, yeah, if you go to Wall Street, they're all naysayers on things. But what I'm reading about crowdfunding out there is what I read about the web when it was growing between '96 and 2000. Now I can't tell you how many analysts I read about who said Amazon's going to go out of business. I mean, there was people out there that were selling Amazon short because they thought it was going out of business in 1997 and 1998. So, the key is that's why I'm so excited about it. Is that's what's going to generate this, and there's going to be a lot more come out of the woodwork than people can even conceive right now, I believe.
One of the things that I've preached and written about, and I'm going to get Kendall your comments on this, is that standardization in the equity space is critically important because obviously debt is very easy to understand. You have a certain risk of default, but you have a certain interest rate. Equity, on the other hand, is a little bit different, and so I argue that you're going to see standardization of deals in the Title III space, which creates a legal tension with whether or not the portals can promote that standardization. Do you agree or disagree, Kendall, with that notion that we'll start to see standardized deals in the equity space?
I think you're going to have to a certain degree for especially as Michael's talking about, the smaller, the 100,000. That's why I got into this. I mean, those were the people I used to help in my law firm. This was the mom and pops who needed $100,000 to start a business, not $10 million. These are people that wanted to open up a little yogurt stand or a ice cream store or something in Tampa. And they needed 100, 150 grand, maybe even 50 grand. And that's, for those people, if they don't have a standardized model, it's going to be very difficult because they can't go hire a law firm to create a cap table and tell them this is how you're going to structure your debt and all those things. So these standardized models will come out, and I think part and parcel of that will be a more standardized way for people in the equity crowdfunding world to do business valuation, which is going to be a big necessity. We all know business valuation is voodoo 90% of the time for a startup. Hey, my company's worth, I haven't done anything, but my company's worth $10 million, okay? I can tell you right now, FundHub is launching in 2 weeks. It's worth $25 million. We haven't made a penny yet. But no, I mean, that's what people do. They say it's this random thing so they can justify their equity structure. There's going to be the need for standardization for smaller deals to be able to go to the public and say, I'm selling 5%, 10%, whatever it is, but there's something in place where people understand it and get it.
David, from your perspective, because you're dealing with issuers and things like that, is that notion that, hey, you kind of have to do it our way, is that accepted by the issuers that you're working with, and do you see that changing?
Well, interesting. I mean, on the investor side, what we see a lot of times is folks, I've had people say to me, well, I put in $1,000. Oh, by the way, what percentage of the company do I own? I mean, it's almost an after the fact because you're not dealing with enough money that folks that on the investor side that they're going to get down. And Kendall said they're not going to go out and hire a lawyer. What I would tell you is they're probably not even going to read the documents. So, I mean, it's going to be similar like, and there's these consumer contracts all over the place, credit card companies and your internet provider and all that. Nobody really sits and reads the fine print. And so I think standardization, yes. We don't tell issuers that here are the terms that you need to be in your offer. We have a starter document and it has some kind of multiple choices. So, and they get to pick what they think is appropriate for their company, what they want to do. They can work with their lawyer. We encourage the issuers to seek counsel on the offer document. So It needs, yes, it needs to be simplified, but I don't think it needs to be dummied down terribly because, like I said, the investors are interested in, they want to be treated fairly, and they will have trust in the issuers. They will have trust in the portal that the deal they're entering is reasonable and fair. I don't think they're going to get into the minutia of the deals, though.
One area that I've done a lot of, like reading and writing, is kind of this trend to crowdfund people, and take future amounts of their revenue from an entrepreneur who might be younger, who might be out of school, who just is starting up. And I want to kick this over to Brian, because he obviously has some insight into this new emergent area, which is, I guess, crowdfunding the equity of people rather than companies.
I mean, one thing you're definitely seeing is diversity in terms of asset class. So it started out as Kickstarter rewards crowdfunding. Now you have debt. Debt is blowing into consumer and commercial. Within commercial, you're seeing all different asset types. And so the mainstreaming, I guess, of investment types is a trend. One thing that's new is that firms have seized upon this notion that I don't want to read your slides and I don't understand what you're trying to do, but I believe in you and I think you will be successful. And it's started out, there's a company called Pave.com where they have rising stars for people who are in their early 20s, some are in college, some are just out of college, and you can actually invest in whatever it is they're going to do. And you may not know what it is, but you can see that they're on the Harvard Law Review or that they're in a successful business venture. And they will give you a percentage of their income over a certain period of time in exchange for an upfront cash payment. And what PAVE says is that's much better than a loan. A student loan is a fixed amount, and who knows if your job's going to support that. This is something that is always affordable because it's 10% of your income. If your income is low, you pay that amount. Your income is high, you pay 10% of that amount. And you don't have to pay if you're making less than 150% of the poverty line of wherever you're living. So it's an interesting concept, and these are being sold off as participation interests, and you can actually, and the idea is that you will mentor somebody and help them along, and that helps you as an investor. The other thing you're seeing now is putting that on steroids, so to speak, with the NFL IPOs. So Vernon Davis this week, who plays tight end for the 49ers, had a public offering list on the Fantex exchange. Fantex is a broker-dealer. They're an alternative trading system, and they have a contract with Vernon Davis where 10% of his income goes to Fantex for distribution to the shareholders. And his shares now trade in a trading range on this. It's not even a virtual exchange. It's an online exchange. It's not NASDAQ or NYSE, but it's a registered exchange that has bid and ask and price discovery, and you have a little bit of liquidity there if you want to sell. And so they've gone down the path of building out a registered platform where instead of buying a football team or buying a brand or buying Under Armour and then you have the overhead of management, et cetera, it's a much more streamlined approach to investing and something that people have grasped upon as a way of understanding. I think you're going to see a lot more of these. I think especially in the NFL where players could literally be cut the next day and not have any money. All of their contracts allow them to have their salaries reduced in order to make room for paying somebody else more money. So imagine if you're in your job and they come to you and say, we need to pay a new coworker more money because we think he's better than you, so we're going to pay you less. Well, that's how these contracts work. If they get hurt, they only get paid through the end of that current season, and then they're on their own in terms of salaries. So it's a very tenuous existence. It's almost a gladiator type model, and to have that certainty to get that upfront payment is something that they really value. So we represent a few other players that are in the pipeline. The next one up is going to be E.J. Manuel, who's the quarterback for the Bills. And you're going to see this as less and less of a novelty as things wear on.
That leads to the kind of follow-up issue, which is it's not necessarily the best to just buy in. It's important to have liquidity and sell out. So, Michael, talk a little bit about how you see the secondary markets developing. How quickly you think that'll happen?
I think that certainly it's well, there's already the private company marketplace where you can trade. I mean, there's the second market, and these guys that were Facebook traded and LinkedIn. You know, LinkedIn traded at $50 a share, did its IPO on the second market, and a year later actually did its real IPO at about $78, $80 a share, and then went, you know, all the way to 200. But so we already have these second markets, and I believe they're going to develop, and the key to their development is going to be the industry data on being available for those companies and their industries. When you think about it, the real estate market would not be a liquid market without the MLS, okay, data. So you can go through any street down here, to any street here in Atlanta, any residential street in Atlanta, and figure out what the houses are selling for, what the square footage is, you have comparative data. So that's going to be crucial. And I believe that a company that I'm involved with is going to emerge as the leader in this space, okay, providing that MLS data to the out there for the whole industry. I mean, that's critically important and needed for the whole industry, for not only for the secondary market, but for the capital moving in to provided by the crowd. Mm-hmm. So I think it's going to happen. I believe that there will be bids and off. That it'll happen by the end of the decade. Yeah.
But just one thing to focus on something that was talked about in the previous panel. Most of these investments are not going to be liquid, with the exception of ones that get out or you can find a market. The Title III rules actually restrict transfers for a year, unlike the Georgia and the Michigan rules. So there are disadvantages, and you should not expect to realize income on these assets. In Realty Mogul, they said that yes, you get a cash flow, but you're not in charge of when the exit is or for how much. In the loan assets, those are generally lend and hold products. They're not. There isn't a secondary market right now.
You know, that leads perfectly into something that Kendall brought up, so I'm going to kick it back to him, which is the lack of discussion about maybe something that turns into what we think of as equity crowdfunding, which is Title IV, Reg A+. Well, I don't even recognize, everybody in the room and online is like the biggest nerd. They probably still don't know what Reg A+ is. So why don't you give kind of a little bit of an overview, and then we can talk a little bit about how that might work.
Reg A+ is a reformulation of a very little used, although people do use it, part of the Securities Act called Regulation A, which allows a public offering to be done. Regulation A, the old law, allows a public offering, an IPO, to be done to raise, but you can only raise $5 million. So it really it's a very expensive process to try and raise $5 million when you can go do a 506B raise that costs a fraction of that and raise as much as you want. It doesn't make a lot of sense to do, and so it's not used very often. There are times where it fits, but most of the time it doesn't. Title IV of the Jobs Act, what people call Regulation A+, actually bumps that number up to $50 million that you can raise, which now makes it viable for almost any small business. So it's an IPO for $50 million, but the biggest, probably most important part of this, if it goes through as proposed by the SEC rules right now, which have gone through the comment period and are awaiting finalization, there would be no state blue sky compliance. So instead of having to go to 50 states and say, I'm going to be selling this securities in your state, well, there'd probably be some, but I mean, there's not the general, you have to register in every state to sell the stock. So removing 50 state regulators and 50 sets of lawyers, as Brian said, from an IPO, all of a sudden makes you have the ability to go to the public, go to the crowd, raise $50 million, and only have to go through the registration really with the SEC. To me, as I've said all along, I think that is the biggest game changer could be the most dramatic game changer in the Jobs Act if it doesn't get changed, and that's the real question. All of the state regulators don't like this law. They all wrote comments to the SEC, very nasty comments to the SEC. The state security regulator from Massachusetts, for example, I've told the story many times, but I love this story, wrote a scathing letter to the SEC about how this is the most horrible law that has ever happened, and the poor people of Massachusetts are all going to go broke investing in these risky startups. And I always like to point out from the Wall Street Journal article in 1980 that the state regulator of Massachusetts, state securities regulator of Massachusetts, famously refused to allow an IPO in Massachusetts in 1980 because at $22 a share, the only state that this IPO was not allowed to be sold in was Massachusetts in 1980, and that was Apple Computer. Too risky. These are the same people now that are saying, we can't have people investing in startups through Regulation A+. Meanwhile, Massachusetts is opening up casino gambling, 3 casinos going in there. Boy, that's a good investment. They have $3 billion in lottery ticket sales every month. It makes a little to no sense. So this is the law, if it goes through, that I think could be a big game changer in the Jobs Act.
Brian, do you agree with that? And I guess more specifically, does this address a little bit of that liquidity issue, assuming that these companies, after doing Reg A Plus, actually become listed companies?
Yeah, no, I do. I think that Reg A Plus has potential to be very big. There are requirements of Reg A Plus that are more onerous, believe it or not, than Title III, such as going through an SEC review process on your disclosure document. The other issue is that with respect to state preemptions, you only have that under Reg A Plus if you offer to accredited investors. And so the free-for-all out to the public aspects of Reg A that was appealing before, albeit with state blue sky, state-to-state restrictions, only go away if you offer to accredited investors. I think it's a losing game for these states. I think that Congress has full authority to preempt them out of existence, and provided that any transaction is engaging in interstate commerce under the Commerce Clause of the Constitution, they have authority to do so, with the exception of the intrastate offering, which they could obviously take an interpretation that anything that uses the wires or the mails or is visible to anyone out of the state is not intrastate. So I would be careful if I were one of those state regulators that you don't, poke the bear too many times. But I think that there is potential. On the liquidity side, it's hard to imagine. Remember, Reg A, they're not restricted shares, so they are transferable, but you're not going to be listed. And if you have a restriction, you're able to trade, but you don't have a listing. There has to be a market that develops somewhere for these where they can trade. If you are raising $50 million, that's the size of many IPOs these days. And you might get better pricing in the listed NASDAQ than in the unlisted market.
From an investor perspective, Michael, what do you think? Let's just start with the predicate, okay? Which is that a lot of the money that's invested on Lending Club is institutional money. And that number is significant depending on who you ask. We'll just say it's in the 80s of the percentile. So do you believe that institutional money needs to come in for you to achieve the numbers you're predicting in the equity crowdfunding space? If so, what are the things that attract institutional investors who might right now be focused on real estate or peer-to-peer lending?
Well, I think I believe that the mass money is going to come in from individuals. 5 years out, if you ask me to look 5 years out, I see significant amounts of money coming in from individuals. Lending Club is a situation where, they have they have 506c qualified investors and institutions who are putting money in there. But speaking of Lending Club, I'm really, I spoke at a conference in New York in December, and one of the guys with Prosper spoke at that conference. And I was shocked at what lending club. Does anybody, let me tell everybody who lending club loans the money to, okay? Will shock you, okay? Lending Club and Prosper are the two big lenders, and about a year ago, Google paid $125 million for an 8% stake of a $1.5 billion valuation for Lending Club, and they bought it from the current shareholders. They didn't give the money to the company, and Lending Club's getting ready to do an IPO. It's probably going to be between $5 and $10 billion this year, and Prosper's not far behind it. But these two companies, they're in the business of actually providing loans to individuals and small businesses that range between $10,000 and $35,000. Okay? Now, I thought to myself, what's going on here? Why are these institutions moving into this arena? And their biggest, and so they're providing loans to these individuals, and what they're looking for is they're looking for people that have medium credit scores. Okay? What they're looking for is the guy who basically misses a credit card payment. He's paying 6% or 7% on his credit card, and the minute he misses that payment, Citibank ratchets the thing to 29%. That's what they're looking for. That's their ideal profile customer. This guy was telling me, at the conference, that they are so sophisticated, Prosper now. That's what these guys, they're out competing for those kind of loans. He said they're so sophisticated, they're going to be able to supply credit at a merchant. They're going to be able to go to the Apple store at some day soon and use your Prosper line, okay, to basically buy, an Apple computer. I mean, this is where this is going, and they're eating. I mean, I was at the conference with Sydney and at Silicon Valley, and what's happening? The local and regional banks are going to get eaten alive here. They're already. Basically, they're going and now supplying the capital to Prosper and Lending Club because they can't afford to make the loans. So, I mean, the industry, the Lending Club is turning everything upside down. And so I think that the more consumers understand what's going on here, and again, the other thing I'm a big proponent of is that you start doing the math, and the other thing everybody talks about is, well, the consumers, there's limits and all this stuff. Under Title III, they limit what the consumer can put in the deal. Hey, I said, what you need to start thinking about is all these consumers putting $100 in every deal, okay? Because what's going to happen is where the world's moving is instead of you going out on a Saturday night or a Friday night, a couple's going to say, hey, let's put $100 into a crowdfunding deal, okay? I mean, that's where the money's moving. So I think the institutions are going to have less power. Wall Street's going to have less power. The traditional public markets every year that goes by for the rest of our lives are going to be less meaningful and less significant. And they're going to give it over to these private capital markets. It's inevitable. Well, look at what happened. You heard the stories, what goes on with crowdfunding on Kickstarter and all that stuff. They're unbelievable. That's where the world's moving onto the individual side of the market.
We have about 10 minutes left. Are there any questions for people on the panel? Raise your hand at any point during these closing comments, because I'm going to start with David. So any thoughts about kind of any of the topics we've talked about today, and kind of the prediction from your perspective about what happens in the equity crowdfunding space?
Well, the last comments about institutional money, I don't know what role that'll have in what we're doing in equity crowdfunding, only because the spending limits, or the most the company can raise, is $1 million under the IGE, the Invest Georgia exemption, and under the Jobs Act. So it's a little bit low for institutional money to get involved at that level. So I don't know. I think that crowdfunding will eat away at institutional money and the need for institutional money. I don't think institutional investors are really going to get involved with crowdfunding. So that's kind of the last comment on that. My prediction is we're getting there slowly but surely. The Jobs Act is supposed to be implemented by the end of the year. That will really transform what we're doing at Sterling Funder. That will really make equity crowdfunding a whole new ball game once it can be done nationally. So I think we're still in the ramp-up period. Us as a company, we're not in a massive rush. I mean, obviously, we'd rather have this moving quicker, but it's a marathon, it's not a sprint. So if 2016 is the big year for equity crowdfunding, so be it. It's better that it be done right, that time, the time spent be good to make it safe, make it secure, make it predictable. So I'm not terribly disappointed that it hasn't happened quicker. I think that the time spent in the infrastructure of the industry and the regulation is a good thing in the long run. So I'm excited about it. I hope everyone continues to talk about equity crowdfunding and get involved and understand that it's as a ready or not, and here it comes.
I agree wholeheartedly with David's comments. It's coming. It's going to be here. And all of us in this room are going to be a part of it in one way or another. It's just important, and I make this point constantly, we all need to educate people. We need to take it upon ourselves to teach people about this. When you're talking to your friends, your neighbors, your church, people don't understand this. I still talk to very high-level people in politics or in the economics world or the broker world. Even people that are in the money world don't know what this is, or they'll look at me. I'll explain equity crowdfunding to people, and they'll look at me like a dog looking at the washing machine with their head turned sideways. You're not going to be able to do that. You can't do that. That's not legal. I mean, this has been a law since April of 2012. And there's people that don't even know it exists yet in the world where they should know. So the general public, about 80% of the people don't even know what Kickstarter is yet. So talk about this. Tell your friends about it. Help people learn about it. That's what this is all about. The more the crowd knows about this, the quicker it's going to actually happen.
Comment from out there. Yep. Rodney, go ahead. Good question, Brian.
Yeah, so Reg A Plus, remember the process is that you have to prepare an offering circular, file it with the SEC. You wait the typical 30 days, get comments back. So it's very similar to an IPO process. You're going to have securities level liability. So a law firm is going to insist on a full diligence process, which would end up with having them render what we call a 10b-5 opinion or a negative assurance letter. So once you go through the various amendments and you actually get things out the door, it's going to be far more costly than a traditional private placement. I don't know how it's going to compare to Title III. The reporting and the documentation process is actually lighter under a Title III model than under Reg A Plus because you have to produce some disclosure document, but it's not reviewed by the SEC. Unless it's something that's complete garbage, and then I'm sure they'll call you. But that is a notice filing in Title III versus Reg A Plus, which is a substantive review of whether you're doing the right disclosure. So I think the legal costs will be higher in a Reg A Plus transaction. But remember, you can raise up to $50 million versus Title III, where you can raise only $1 million. In the accredited Title II world, there's an unlimited amount you can raise. You don't have to do a substantive SEC document. You don't have to engage a funding portal, and you essentially are free to market and solicit in the same ways under crowdfunding or Reg A Plus. So what I've noticed is there's actually a public policy issue here in that the waterfall of choices that a company or an issuer would have when they're looking at their fundraising choices. Obviously, it starts, if you have a check from a venture firm, you're going to take the check unless you have some real reason not to. Then you move on to private placements. If you can't do a private placement, you'll move on to potentially crowdfunding or Reg A Plus or interest state. By the time you get down to to the Title III world, you've taken an asset class which is extremely risky to begin with in startups, and you've narrowed them by those that effectively no one else wants to invest in. And then you're taking that asset and you're offering it out to the riskiest slice of the investment world, the general public. So what I wrote in a publication that was in Forbes is that there's a potential for a train wreck here. And I think there's a theory that this is really a rule Congress never wanted. They've layered this thing on in order to make it unworkable, and there's no amount of SEC work that can really undo the Jobs Act, and the Jobs Act creates something that's not economically viable. Some people don't realize when the Jobs Act went from the House to the Senate, the bill that came out of the House had a $10 million limit. It had much higher investor caps, and it was something that sounded a lot more reasonable. Senate, mostly Senate Democrats, including Chuck Schumer, my senator, Dick Durbin, the two guys in Oregon, basically said, we're not voting on this unless we have adequate investor protections for crowdfunding, and they came in and 10 million became 1 million. You had to use a funding entity. Funding entity had to be registered with the National Securities Association, which is FINRA. So all of those restrictions have gone in, and obviously they're good for investors, but they make it so costly that it's more expensive to do crowdfunding than, for example, an IPO. Take your fees as a percentage of what you're going to raise.
And further to that point, I think that the analysis will show that for companies that might have done a reverse merger, that sort of activity, that you'll see a trend toward probably Reg A plus. It'll be cheaper probably than doing that. Certainly a lot cheaper than doing full IPO. And so for a company that is looking to probably become exchange listed, if nothing else, raise a lot of money, I think that it'll be significantly less cost than what exists today, but it's a lot of money.
Right, but remember under the Jobs Act, the disclosure requirements for IPOs actually went down. So instead of 3 years financials, you only need to show 2. You can have meetings with investors before you file. You don't have to comply with Sarbanes-Oxley for the first 5 years. So the Title I, which is the IPO on-ramp, actually brings an IPO cost, when you consider the liquidity you have and the trade-off you might have in pricing, a little bit more in line with Reg A+.
By the way, I don't think that Reg A+, if there's one thing that's not going to come out of the oven like everybody thought it was going to come out, it's going to be Reg A+. Because what the issue here is, I think it's a real long shot. Okay, because the states, remember, the states they want to be able to generate the fees. Right now, under the current environment, the company goes in, they got to file with the state and pay the fee, okay, for the investors in their states that are coming into the deal. Regulation A+, it's going to take all that out of the hands of the states, and that's a big, it's a big downer for the states, and I don't see, that's why they're fighting tooth and nail against it.
But the Reg A+ is not really comparable to Title III, because you can't go to the public unless you're willing to do all the state filings. And it's not just a state filing. You could get a letter back from the California Corporations Department that has 50 questions for you to answer and add to your disclosure. So if you want to do that with every state, you certainly can. But again, getting back to the cost, what is going to get me the most money for the least amount of cost? And going through a state-by-state registration process is not efficient. Ask people in Canada, where most of the things are deferred to the Ontario Securities Commission, and unless you're doing Reg A+, then you're back to only going to a creds, and you might as well do a 506.
Right.
And probably going back to Michael's,
506C.
and probably going to Michael's point, a lot has to do with what the cooking looks like. Because obviously, if it comes out like you're going to go state by state, then it won't work. And we've learned that. One last, and then we can go have some lunch.
My question is about an example operating agreement. Supposing that an instrument comes for set up agreement for not an LLC, in cross state, just one state. For example, Georgia. I've been sent there by some people who are talking from Florida that really do want to get educated, like you said, and want to get informed and inform other people, investors, and better small business
Yeah, let me turn this one to Kendall, but with the kind of caveat that this goes back to a little bit of the standardization discussion, a little bit of, we'll call it the legal zoomification of, you know, the way that law needs to be practiced in order to have these smaller companies be successful. But Kendall, why don't you make comments about what you see happening there?
No, that it's funny because you have a very diverse group of, well, three especially lawyers who have very, very different practices here. I'm a sole practitioner. I've been a sole practitioner for 17 years. I've handled huge transactions that major law firms with thousands of people would normally handle. Now, I've represented professional athletes and done multi-million-dollar contracts where I sat down with Bill Ford, the CEO of Ford Motor Company, in his office, just me and him. But I'm a sole practitioner, and so I look at Regulation A+, for example, and I see all these issues that are out there. But I also know if I send it over to a 1,000-man law firm, they're going to charge $250,000 for somebody to do this. Guess what? There's a whole lot of lawyers out there who are going to do it for a lot less. It's going to be a lot different change in this world of practicing law as a result of this. It has to be, because for these things to work, and first of all, there's lawyers starving out there all over the place, just like everybody else. They don't all have jobs. They need to do this work. They need to generate these fees. So you're going to see the market for these legal services come down. It's going to happen because it has to for this stuff to work. And I can tell you right now, I talk to people, to answer your question directly. One of the things we're doing, and people at Pepper Hamilton will probably look at me and go, "You're an idiot," and we're laughing at you, and I understand. But they're going to say, one of the things we're doing at FundHub is we're going to generate form private placement memoranda for people. So guess what? You're going to be able to go on our site, and you're going to be able to generate a PPM. And every big law firm in the world that charges $250,000 to do these things is going to look at me and go, "Well, that's idiotic." Well, guess what? I have about 50 lawyers who have already come to me and said, "We'll review it and issue opinion letters for $2,500 for people so they can do this whole thing for $5,000. Okay? Now, take that into the equity crowdfunding world, Regulation A world. And listen, I know I'm oversimplifying it here, but I'm saying there's going to be a dramatic shift in the way that it's done. Lawyers hate what I'm doing, for the most part, and they're going to, and I understand it. I'm a lawyer.
I like that.
But that's not the point. I'm not trying to chase lawyers away. Listen, there are deals that I wouldn't touch with a 10-foot pole to go through this thing either. But for the simple, straightforward raise, it's ridiculous that you have to pay a law firm $50,000 to generate something that they push a button on and change the names. Because I do it. I know. And so that's what's going to happen. You're going to see a lot of a dramatic shift in the law practice where some of the, listen, there's still going to be a huge need for the multi-million-dollar complex deals to go through big firms. But you're going to see a lot of securities practitioners that step in and take care of this. I'm too busy speaking. Oh, no.
David, why don't you talk about the portal space and then...
Yeah, I agree with what Kendall said, that there'll be, in the accounting space and the legal space, the service providers will come around and have tailored services for equity crowdfunding. So I agree with Kendall fully on that. And to answer your question, we're doing this day to day, and we don't have an operating agreement I can send you because almost all the companies that come to us already have an operating agreement, okay? We have sort of the documents, I think, that are required for equity crowdfunding after that point, but most of them already have an operating agreement. All I would say about that, I don't think anything, the lawyers could talk more about that, but what needs to be in that operating agreement, certainly there needs to be some allowance for, or prevention of anything that would stop an equity crowdfunding raise from being in there. So sometimes the operating agreement may limit the number of investors, for example. So there would be tricks that and things that you can do in the operating agreement that would facilitate an equity crowdfunding raise. But we just don't have that document because there hasn't been a need for it.
Final comments from Brian?
No, I just I also agree with Kendall. I think that the legal costs are going to be too high in this area, and that they will have to come down. We do represent a lot of startups, a lot of unfunded startups. We have a whole emerging company program where we, for a flat fee, do startup docs and fee deferrals and all of that stuff. Probably you would be surprised. And I think that in the situation where you see your disclosure is going to a point-and-click model, it's a very dangerous slope that you go down. And the point of a disclosure document is to inform people about the company or the business or the project in a way which allows them to make an informed decision. And there has to be some degree of customization there. It can't be something that you generate in 10 minutes. The securities laws are very clear, especially in the Title III world, that they're going to impose what we call IPO level strict liability on misstatements in offering docs in crowdfunding. And somebody will be going to jail shortly after the rules come out because they have a misstatement in their docs. If it's egregious, they might have criminal charges. If it's not, then they'll have civil penalties. And if you have any misstatement that's material in your documents, then you have to offer all of your investors the right to their money back. That's the rescission rights under the securities laws. So I think that in the race to be efficient and all of that, you still have to keep that in mind and be very mindful that every deal does require some thought in conveying to somebody the adequate risks involved in their investment.
I want to thank everybody and let everybody go off to lunch. I especially want to thank everybody on the panel because it's been for a group of people that kind of look like a bunch of middle-aged white guys. There's been a lot of diversity of opinion, and so I think that's been very important and appreciated. Let us know if you have any questions individually, but otherwise, Sydney, do you have any announcements, or could I let everybody leave? All right, good. Great. So the announcement is it is in fact lunchtime, and there is lunch next door. You said Sid? Downstairs.
At Subway.
And so we'll follow Sid. We'll all go to lunch, and then we'll reconvene here at what time? Sydney, I know